Good evening. You can see Maggie, Luinda, Sreleko, Tapio, and Trevor. Good
Good
evening, all.
evening, Director. Good evening, everyone.
Good
Okay.
evening. Good evening, everyone.
Okay, so guys, today it's more to do with theory. Like I said, that with financial modeling, you first need to have an understanding of basic accounting. That is what we'll look at today. We'll be meeting on Saturdays, Monday, almost the same time, and Wednesday. So 3 times in a week, so to say. So we'll start with we'll start with accounting fundamentals for financial modeling, understanding the three statements and how they link. These three statements, you have the income statement, you have the balance sheet, and the cash flow statement. Yes. So module one, we'll look at the big picture, how the just to have an understanding of these three statements. But maybe the issue here will be just to check that the financial statements, like I said, there are three most important statements. You have the income statement. The income statement basically uh, shows the revenues and the expenses. This is where you're able to get your profit. And even by definition, profit is excess income over expenditure. So we'll look at those. So moving, let me do this. Mhm. So we'll move beyond, the objective is to move beyond accounting theory to modeling application. Here again, I need to state that this course, it is not trying to make you pass your CA exams, CIMA, ACCA, ZICA, or to be a CPA. No. We're trying to build a dynamic simulation of a business. And to do that, we need to understand the physics of finance. Say if I spend cash to buy a factory, how does that look on the paper? If I sell a product on credit, why does my profit go up, but my bank account stays the same? That is what we'll be solving today. So to understand the purpose of the three main financial statements, why they are there, learn the specific line items that drive financial models, and master the plumbing, how the statements link together. Hello, are you able to hear me? Hello?
Yes, Director.
Okay, thank you. So module 1.5, look at the core accounting principles for modelers. You just need to understand the underlying assumptions, the principles such as the matching concept, going concern. These are things that need to be understood for you to model nicely. So we have the accrual versus cash basis. There is a concept in accounting called matching concept, and it states that revenue earned must be matched against expenses incurred in earning it. You have the open line, which is basically the cash basis. Say, for example, huge spike of cash received in January. That is cash. You may have a bottom line, which is accrual basis, revenue smoothed out evenly over 12 months. And ideally, that's a concept when you look at depreciation. Or you're saying that you have an asset, for example, you have an asset that you bought at 1,000 kwacha, for example. And the economic lifespan of that asset is five years. So it means that on an annual basis, you'll be matching the revenues against the depreciation of that particular asset because you believe that this is the asset that has helped you to generate revenues. So meaning on an annual basis, you'll be depreciating because it's a 1,000 cost or historical cost of that particular asset. You divide by 5, you get a 200 kwacha, meaning to be 200 kwacha depreciation on an annual basis. And that 200 that you are matching against the revenues that you are earning in that particular year. So the concept cash basis, record revenue, and expenses when cash changes hands. Basically, that's on cash basis. But accrual basis, which the IFRS and general accepted accounting practices. IFRS is basically the international financial reporting standards, which we are ascribed to, especially Commonwealth countries. Then in America, they use GAAP, which is generally accepted accounting practice. They all agree that you have to record revenue when earned and expenses when incurred, regardless of cash flow. So even if you haven't received cash, you have to record those expenses. That is accrual basis. And like I said, this is basically the matching concept. And by definition, I'd already stated it, it is revenue earned must be matched against expenses incurred in earning it. Why it matters for modeling. So you as financial analysts or financial modelers, why should that concept, the matching concept, matter? One thing you need to know is that the financial models are built on the accrual basis. This is why we need a cash flow statement to translate the accounting profit back into actual cash. So it is possible having a company that generated, for example, a $1 billion profit, but they're bankrupt, or that company is bankrupt. Yet in that year, it actually generated $1 billion. You have to understand the concept of accruals. So this is the most critical concept that you should always appreciate when you're doing your modeling. For example, if a company signs a $12 million contract for a year of consulting, but gets paid upfront, the income statement only shows $1 million of revenue in month one. However, the cash flow statement will do what? It will show a $12 million coming in. So if you don't understand this difference, you cannot predict the company's bank balance. For example, you buy raw materials on credit, you have the expense, which is basically the cost of goods sold and the inventory, but you still have the cash until you pay the invoice. So it is very important team to appreciate this concept, which is accruals. You'll be using it as we move on because today, obviously, it's just a theories. On Monday, we'll actually get now into Excel. First, I'll train you on just the basics of Excel, just the basics, just you to understand, to appreciate, to feel very comfortable working on the spreadsheets. Once you get to understand the basics in Excel, then now we can move on and start looking at the modeling component of it. This is to try and actually put all the three financial statements in context and to be able to model them with much ease. Where we're going to be very interesting, and I hope you have your laptops and you have Microsoft Excel. So this matching principle, what is the rule? I'd already mentioned. Expenses must be recorded in the same period as the revenues they help to generate. What's the application? If you say a product today, the cost of making that product must be recognized today. Even if you paid for the materials last year, we are just matching. Depreciation, we don't expense a 10 million factory in year one. We match the cost of the factory over its useful life. Is it 20 years? Because it helps generate revenue for 20 years. So what is the modeling implication? This drives how we focus margins. You'll be taught on how to do the forecasting, guys. They are quite interesting tools in Excel that we'll be using to forecast. Quite interesting tools. Here we have revenue recognition, which basically is the when. When do you recognize revenue? So when does a sale count as a sale? So we look at the key criteria. Evidence of an arrangement exists. So if there is an arrangement or an agreement, and you are able to demonstrate that this agreement exists, that's the first thing. Secondly, delivery has occurred or services rendered. So if I receive, say I wanted to buy, I intend to buy some books from, or a book from Bookworld. When I receive that book, it means the sale has actually been recorded. Price is fixed or determinable, and you are able to collect, or collectibility is reasonably assured. Then you know that revenue has actually been recorded. You need to understand or appreciate that there are standards to each and every, most of these important elements that we are actually discussing today. Like revenue and IFRS, we have a standard that actually guides us on how revenue must be recognized. You have the deferred revenue trap. if cash is collected before the service is provided. We see all these like airline tickets, software subscriptions. You have what we call it is a liability, deferred revenue, because you have collected you have actually paid even before the service is provided. So that is called deferred revenue. These are also two concepts or underlying assumptions that are very important in accounting: materiality and conservatism. There are certain things that may not be very material, and those that are not material, as long as they don't actually change, they have no bearing on whatever decision that you have to make. These are small elements that instead of having them uh, on your financial statement as headline elements, you can actually aggregate them and have them in mauve. Instead of aggregating, you can actually aggregate it instead of just having it as a single line. So financial statements only need to be accurate enough that errors wouldn't change a user's decision. Here, modeling tip is that don't model every single pencil purchase. Group small expenses into general and administrative. Keep the model simple where detail doesn't add value. As we get into modeling, you'll be able to see how we actually use these principles effectively. On conservatism, here the concept is that do not overstate revenues and understate expenses. You have to be very moderate. When in doubt, choose a method that results in lower profit or lower asset value. Anticipate losses, but do not anticipate gains. So the modeling tip here is when projecting, it is better to be slightly conservative on revenue growth and slightly aggressive on cost assumptions to build the margin of safety. Historical cost and fair value. Balance sheets. When you look at the balance sheet, I know I should be looking at that. When you look at the balance sheet, it has assets, a section of assets, which is the first half. The second half of the balance sheet, it looks at equity and liabilities. But these assets, they are recorded at historical cost. And there is this principle because I think it just makes things much easier. Assets are recorded at the original purchase price, not their current market value. Why is it so? It is objective and verifiable. So if you bought a vehicle 5 years ago at 100,000 kwacha, the balance sheet that you had 5 years ago, it will definitely show that asset 100,000 kwacha. And on an annual basis, you'll be depreciating it, but the cost of that particular asset, it will be 100,000 less accumulated depreciation. So the modeling implication is that the book value of equity, which is assets less liabilities. So assets less liabilities, it gives you equity. There is what we call the accounting equation or business equation. The accounting equation is where you have assets equals liabilities plus equity. And it should always balance. When now you go into your business equation, where the business has started and you have started generating profits, and those profits, they'll be added to your equity. So we modeled find the intrinsic value because the balance sheet does not show it. So we're going to module 2, which is basically the income statement. This is the first statement of the 3 statements, and this is where you start from, guys. Like I mentioned, the income statement is just a list. It just lists the revenues, other income, your expenses. And what you're able to get down there is either it's a profit or loss. And by definition, profit is excess income over expenditure. So the income statement profitability over time. First, the income statement is more or less like a video. It's video recording. Whereas the balance sheet, it is a photo. So even when when you do your income statement, you always say for the year ending, for the month ending. Whereas for a balance sheet, because it's as, so you always use balance sheet as at 31st December, balance sheet as at 2nd January, whatever it is, it's a position. But for the income statement, it's more or less like a video recording. So it is a record of revenue and expenses over a specified period. And it's easy because that is how you can determine the income statement basically looks at performance of the company. Ideally, that's what it looks at. So the golden equation is revenue minus expenses, you get your net income. That's it. But what are the key modeling drivers? On revenue, what are those drivers that when we go into modeling, you need to understand these drivers and come up with assumptions? Say, because obviously in the energy sector, you have the tariff, which is basically the price. You have the quantities. So price times quantities, it actually gives you the revenue. Then you have your cost of goods sold. These are direct costs or what we call prime costs. These are costs that are associated with the production. Then you have other expenses, which requires operating expenses, SG&A, research and development, marketing, etc. So critical profitability metrics, like I said, the income statement just helps you to understand the performance of the company. You can come up with key metrics that helps you to determine whether the company is performing well or not. You have your gross profit margin, which is basically revenue less cost of goods sold. How efficient do we produce? So for example, in the energy sector, the company that you guys work for, you have your revenues, your cost of goods sold. It is basically the cost of sales. Here, it's the maintenance of your generation, transmission, and distribution. The depreciation for those assets, for the primary assets that you use to generate that particular power, which you are able to sell. That will be your cost of sales. The water charges, in this case from Zambezi River Authority, that will fall under cost of sales. I've mentioned about maintenance. Depreciation, it will fall there. And also the direct costs such as direct labor. for those that work in the power stations, for those that actually work under transmission, and also distribution. Not support staff. Support staff will fall under other expenses. There's EBIT, which is earnings before interest and tax, and you'll be seeing most of these when we start looking at actual financial modeling. This is earnings before interest and taxes. It's basically the core business profitability. But a key metric is EBITDA, which is earnings before interest, tax, depreciation, and amortization. Amortization is basically depreciation of the intangible assets. This could be trademarks, though trademarks, they don't. You amortize, you don't depreciate, you amortize. The customer's list, that is an intangible. So it is crucial for modelers. It's basically a proxy for operating cash flow. So if you check even the 10-year financial model, I'm sure you have access to that financial model, or you should have access to that financial model for your company. You will see that most of the important metrics in that financial model is basically the EBITDA. I think there was a target that the EBITDA by 2027, it should be at an EBITDA of 30% of revenue. So your net income is the bottom line available to equity holders. So what happens here? Let me just explain. You have your revenues, you have your expenses, two types of expenses, obviously. You have your cost of sales, and you have the other expenses. These other expenses, you, they are not direct. They are not direct costs. They are basically overheads. Then you have your taxation, uh, interest, if at all that company got a loan. Down there as a bottom line, you have your profit. This is the profit, guys, that is connected to your balance sheet and equity, or what you call retained earnings. So it goes and adds to your retained earnings. It grows your balance sheet. And that is the only way, that is the only route in which it finds itself in the balance sheet. So your income statement, whatever things that you have in the income statement, the objective is to actually get the bottom line, and that's the bottom line that is connected to your balance sheet. So we go to module 3, which is the balance sheet. Here, when I look at the balance sheet, I always look at the first half of the balance sheet is more or less like the eyes. The last part of the balance sheet is the ears. But at any given time, the balance sheet needs to balance. What you are able to see and feel, those are assets. And that's why I say it's the eyes. The ears are things that you actually hear. Even in our own setups, in our communities, we always say, because obvious things that you're able to see someone who owns vehicles, they change vehicles, or they have houses. These are things that you're able to see. The question is, how were they funded? It's things that you hear. No, it was a bank loan. No, it's basically uh, parents, parents funded those assets. If you do not have a clear answer. Mostly what happens in our society as Africans is that those were actually funded through witchcraft. Actually, we don't even say witchcraft, we say Satanism. I had mentioned about the accounting equation. It's a very important equation. It's basically the balance sheet. Like we say, the balance sheet is a snapshot of the company's financial health as a single point in time. What is this accounting equation? It has assets. Assets should equal to, so assets, this basically are the things that you have, things of value, and how were they funded? Is it in Congole liabilities? Is it equity, which is basically contribution by shareholders? So your assets will equal to your liabilities plus shareholders. This is the accounting equation. The business equation, it is when the business has actually started generating or has started operating, meaning that you have your assets equals your liabilities, your shareholders equity plus retained earnings. Guys, this is the modeler's headache, which is the working capital. We usually, to optimize the financial models, we usually spend a lot of time on modeling working capital, and it's called working capital engineering. Under working capital, you have three items there. You have the receivables, or others will call them as accounts receivables. These are sales made, but cash not yet collected. You have the inventory, which is goods waiting to be sold. And you have accounts payable, which is basically bills we haven't paid yet. We could have gotten goods from the suppliers and we haven't paid them. Someone could have bought from us and they haven't paid us. Those are accounts receivables. For accounts payables, we bought the goods and we haven't yet paid them. So in modeling, these are components. That's a component that we really pay a lot of attention. So you have, for example, two balance sheets, maybe for the previous year and your current year. You need to actually check whether there's an increase in receivables or a decrease in the receivables. For example, when there's an increase in receivables, it means that that difference, that increase in receivables, is a cash outflow. If there's a reduction in accounts receivable, it means that it is cash inflow, because then you have reduced the receivables. It means that someone actually paid. Any increase in payables, it is regarded as a cash inflow. A decrease in payable, it is a cash outflow. So this is where you have to spend more time as a modeler. This is the modeler's headache. Module 4, we look at the cash flow statement, issues of liquidity. Cash, they always say cash is king. I did mention to you that the company can be profitable on the income statement, but go bankrupt because they ran out of cash on the cash flow statement. So in modeling, we usually use the indirect method, starting with your net income and start making adjustments, adding back, for example, depreciation because it's a non-cash item, looking at the changes in working capital. So the cash flow statement has three elements. And it's very interesting because those three elements, they are actually a proxy of decisions that are made in a company. You have decisions at operating level, and this is why you make decisions. This is why you decide as executives on whether dividends, for example, have to be paid or not. Then you have your cash from investing. Here, under cash from investing, this is why you have your capex. If you had any disposals of those assets, you show that under that particular line. Then you have cash from financing, raising debt or equity or paying dividends. Hello, are you there? Hello?
Very much available,
We're
Okay,
Director.
thank
here.
you, thank you, thank you.
Listening.
Yeah, sure.
We're here.
Okay,
We're here, Director.
okay, thank you. So reconciles, the purpose here is to reconcile net income, accounting profit to actual cash generated. Why is it needed? Because net income includes non-cash items such depreciation, and this is why we will be adding them. Once we start doing the modeling, you'll be able to see that. So the structure of the cash flow statement, you have cash from operations. This is basically the core business activities. You have cash from investing and cash from financing activities. So module 5 is basically the plumbing, linking the statements. So link 1 is basically the net income, like I mentioned to you. That's a profit that goes into retained earnings into the balance sheet. So you have your net income, you have depreciation. This depreciation, it adds on already. Depreciation, basically, it actually reduces the asset value because you have your asset which is recorded at historical value, less your accumulated depreciation. Then it gives you your net asset. Then you have your capex, which is an outflow on your cash flow statement. Number 4 is basically debt. Here you have interest expense on the income statement. For the interest during construction, which we call as IDC, it will not actually sit under the income statement. It will actually be capitalized, goes into the balance sheet. Then you have your cash balance, which is link 5. And that is how you actually put all these elements together. You have your income statement, you get your net income, it is added to your balance sheet. Under your balance sheet, it comes under retained earnings. From there, you have the two statements, which is the income statement. Your income statement, what it does for your own information, it is under the cash flow statement. The income statement, the elements in the income statement will fit under the cash flow, under the operating cash flows, the CFO. This is cash flow from operating activities. It will sit under that particular element. The balance sheet, where you have your assets, that is actually going to sit under line number 2 in the cash flow statement, which is the CFI, cash flow from investing activities. Same even on the financing part of it. So when you develop these models, you will also need to create some schedules, or others will call it as schedules, supporting schedules. Under this, you have depreciation schedules. It will track your property, plant, and equipment, capex, and calculates the depreciation and amortization expense. You have the debt schedule, which tracks different tranches of debt and interest rates. We'll be going into this in detail. You have your working capital schedule, forecast, accounting receivables, inventory, and accounts payables based on historical days. There, that is where you deal with what we call working capital engineering. So summary and best practices. One, consistency, where you have historical formatting must match projected formatting. Here you learn as we move on team, financial modeling has its own standards. You can download those standards from Google. It's called FAST, FAST. These are standards that you need to acquaint yourselves. There are standards like, for example, for hard-coded numbers, for hard-coded elements, we actually put them in a blue font. For formulas, where there are formulas, the font is black. You have usually a cash or a revolver line of credit, which acts as a plug to make the balance sheet balance. You will need to do sanity checks. Does the model balance? Are margins realistic? And if your balance sheet is not balancing, it means that there is something that is fundamentally wrong and you need to fix it. So the question here on Trace the Dollar, if the company buys $100 machine with cash, remember that that machine is an asset. The question is, how does this affect all three statements? In the income statement, there will be nothing there because you haven't started your business yet. You haven't generated revenues. There are no expenses that must be matched against the revenues that you should have generated. So it will be zero. In the cash flow statement, it will show cash of $100 as a cash outflow. In the balance sheet, it will show cash down by 100. Property, plant, and equipment, it will increase by 100. And the balance sheet is going to balance. That's it. So, I'm done with today's lecture. Just wanted to make you understand the financial statements because you'll be dealing with those financial statements. We need to be able to model. In the next 2 weeks, you'll be able to model starting from scratch up to building a full workable financial model. And we'll be very basic. I'll be very basic in taking you step by step, and I'll be very patient with you. But Monday, we'll start looking at basic Excel. Shortcuts, rules, formulas that you are not supposed to use, and Excel functions, key Excel functions that you need to know and be comfortable with. I'll send the presentation, maybe not today. Give me time, probably tomorrow morning I'll be able to send. So as a tradition, I always ask for your feedback, what we call checkout. You just comment what you have learned and what is expected in the days to come. We'll start with Mkonka. Hello?
Hello. Thank you, Director, taking us through the first part of financial modeling in understanding the the different statements, the financial statement and the balance sheet and their importance. We'll definitely take time to keep reading through so we can better understand the points that you brought out. And so we can understand those headaches that are usually there and better apply ourselves as we start going through the financial modeling on Monday.
Sure. Thank you. Maggie?
Thank you.
Good evening, Director. Good evening, everyone. Thank you so much for this insightful class that we've just had. It's actually an eye-opener for some of us that are coming from theoretical schools, unlike the financial aspect. So I feel it's going to be very interesting getting to know the financial part of financial modeling. And also, like you've mentioned, that you are going to be very calm and very steady in taking us through the lesson. Thank you so much.
Yeah, thank you. Thank you, Maggie. Lovinda?
Good evening. Thank you for taking your time to show us financial modeling. I learned about fast standards, my first time hearing about them, and I'm excited to learn more about financial modeling. Thank you.
Thank you. Chirereko?
Good evening, Director. Good everyone. Good evening, everyone. Thank you so much for taking time to teach us about financial modeling basics. Personally, I'm very interested in tying financial modeling to our ZESCO agenda. Sorry, I got distracted.
Okay. Thank you, Chirereko. Trevor?
Hello?
Trevor?
Evening, sir. Hello, can you hear me?
Yes, we can hear you.
Yeah, evening, sir. Thank you so much for the run through the different types of models, and we are grateful for the time that you've taken and the patience. We are really grateful. We're looking forward to see how all these different statements are used in the moduling, the actual moduling. Looking forward to Monday. Thank you.
Thank you. Mtale?
Good evening, Director and everyone. Thank you so much, Director, for taking the time to run us through the course, through financial modeling and just understanding basic accounting. Today, one of the things that also stood out for me is how one single transaction is recorded differently in the cash flow, the income statement, and the balance sheet. We really appreciate this time, and accounting is something I've dodged for my whole life, but I think I have no option at this point but to learn. And thank you for just starting with the foundations. Thank you.
Thank you. Tapio? Seems Tapio is not ready. Agnes?
Good evening, Director. Good evening, everyone. Thank you so much for taking us through the steps. So far tonight, I learned about balance sheet being a photo, and the first part of the balance sheet being the eyes, then also the income statement being a video. It shows you the state at which a company is at or how it's doing. So I'm looking forward to learning more and exploring more. Thank you so much.
Thank you. I don't know who this one is exactly. Please identify yourself. and check out.
Good evening, Director. Good evening, everyone. I'm actually on leave, but when I saw something that mentioned to be online, I thought of joining. I'll be coming for it next month. Otherwise, thank you for taking your time to teach us. We've learned a lot, and I've also understood the cash basis and the actuarial basis, and how the belt is on the actual basis. Otherwise, thank you, Director. Looking forward to come back next month and to learn more. Thank you.
Thank you so much. So guys, we meet on Monday at 20:30. We have a lovely, lovely, lovely night. And keep on working. Keep on perfecting your skill set. I think that is very important. It will help us as a directorate. I'll dedicate my time to train you in things that actually matter most. Thank you so much. May God bless you.
Thank you.
Thank you so much.
Thank you. God bless you too.
So,
Thank you.
Thank you.